Hello and welcome, everybody. Welcome back or welcome to Sectors Made Simple. Here, it is our goal to be able to provide education, resources, and tools to help investors discover parts of the market that are performing best at any given time. But much of the market's performance can be due to things outside of the market, most notably our economy. It is no surprise that the market pivots heavily based on economic data releases and what key economic policymakers are saying. So, because of that, we felt that it's valuable to share resources and education on how we can monitor the economy and also answer important questions like, will we see a recession in 2024, or are we already in a recession? I have my opinions, and I've used a lot of different data points to come to this conclusion, so I want to share those with you. If you enjoy the type of material that we cover in this webinar, know that we do monthly reports for our Sectors Made Simple subscribers, very similar to the webinar that you're watching right now. So, in addition to all the investment tools we provide, we do these educational economic updates to help our subscribers stay informed and on top of everything, market, economy, and more. But with that said, let's get into what I have to cover with you all in today's webinar, answering, will we see a recession in 2024? Please note, everything I share today is truly my opinion. I love doing research, I love crunching data, and I love getting to share with you all why that data matters. But ultimately, I am a data analyst, and an analysis is simply my way of turning numbers and data into insights and findings. I encourage you to do your own research as well. If you look down in the description, there is a giant list of all of the different resources and websites that I used to create today's presentation and come to the conclusions that I have. So I encourage you to listen to what I have to say, but also go and check the sources yourself. Scroll through them a little bit and see if you have the same opinion or a different opinion. Please trust but verify. That is always something we emphasize here. So, let's get into it and talk about the goals for today's session. All of our goals are going to center around answering two questions. Are we currently in a recession? And will we see a recession this year? We're going to take a look at a lot of different economic indicators, both current and historical results, as well as future projections for our economy. We're going to talk about what the Federal Reserve's goal of a soft landing actually is. Probably heard the term, but how realistic is it, and what does that actually mean? Those we'll answer and take a look at, as well as I will share my personal opinion on the answers to those two questions and share with you the reasoning that I used to come to that conclusion. Now, you're probably thinking that all of this is really cool information. The webinar's an hour long. I assume it's going to be an hour long. So, if you just want to get the answers up front and be able to move on with your day, I understand that. So, let me give you the straightforward answers, and then if you're interested to learn more about how I came to these conclusions, so you can do the same for yourself right now, or you can do this for yourself in the future. Here are my answers. No, I do not think we are currently in a recession, and no, I do not think we will see a recession in 2024. Still here? Cool, I'm glad. Let's actually provide some context behind these two answers and, again, my opinions. So we gotta start off super basic here. What actually is a recession? Because before we can answer the ifs about if we're going to see a recession or not, we also need to answer the what is a recession. So, really, a recession is a period of economic decline. It is a period where our economy is growing, and all of a sudden it's not growing anymore and it slides backwards. This decline can last for anywhere from a few months to a few years, and it can be a combination of different factors depending on who you ask. One of the most common is decreased GDP, or gross domestic production. How much stuff are we creating? During recessions, we would expect to see that GDP decline. The amount of stuff we're producing goes backwards year over year. We would also expect to see rising unemployment, falling retail sales and consumer spending, and contracting industries, shrinking industries such as manufacturing. Now, what actually constitutes a recession? What is the definition of when we are in a recession or not a recession? Well, ultimately, it depends on who you ask. One of the most common definitions, and if you're familiar with the recession, this is probably the definition that you might think about. It is based on a 1970s definition by an economist named Julius Shiskin. Hopefully I pronounced that correctly. His definition was a recession is 2 consecutive quarters of the year of GDP losses. Meaning our GDP gets smaller, in the next quarter it gets smaller again. This definition also expands to a depression, a period of prolonged GDP losses. This definition became the standard, and again is probably what you've learned about in your macroeconomics classes, or you might have heard about from different news publications. It's the go-to. It's simple. You look at one number, that's it. But that's one economist. There is a national bureau called the NBER, or National Bureau of Economic Research. Not as fun as one economist's opinion, but definitely more comprehensive. They define a recession as a period of significant economic decline, lasting more than a few months, where there is income decline, unemployment increases, decreased industrial production, and decreased retail sales, as well as a decrease in consumer confidence. Well, 2 consecutive quarters of GDP losses, a laundry list, a partridge, and a pear tree. You take your pick of which one you think is easier to explain, but there's a reason for that. The reason is that defining a recession is not as simple as 2 consecutive quarters of GDP losses. And that's the reason why we are still having this discussion months and years after this recession was supposed to begin. I remember back in 2022 doing a webinar for SMS subscribers where we asked, are we entering a recession? 2 years later, here we still are. Why? What's taking us so long to come up with an answer for that? And more importantly, why does that question even matter? Should we ultimately fear a recession? Is this really the boogeyman of our bank accounts and the economy? Well, emotions aside, the logical answer to this question is no. Whether we like it or not, recessions are a natural part of this idea, this concept known as the economic cycle. Our economy grows, and at a certain point that growth is unsustainable. It shrinks a little bit, gets back in balance, and that recession, that economic pullback is the more general term for it, is a way of resetting things that are out of balance. And by clearing out old space, we create new space for future expansion. A recession is not the same size, it is not the same length as expansion or growth. Periods of economic expansion are longer and create more gains then periods of recessions and economic pullback. So really, it's not a cycle going sideways. Instead, it's a cycle that kind of goes up, like a really, really terrible staircase. My ankles hurt just thinking about it. But to give a better example of the economy and the role that recessions and economic pullback play in our economy, to me, I like the analogy of a recession and an economic pullback is like a wildfire for our economy. I don't think it is a point of debate. Wildfires are destructive. People lose their houses, people get displaced, they cause a lot of fear and a lot of panic and a lot of uncertainty, especially when they're growing out of control. But the reality of it is, even before humans were around, wildfires happened. They'd clear out all of this undergrowth, all of this old kind of dying, all these dying plants and trees, and create new space for future growth. Unfortunately, recessions are the same thing for our economy. Now, it doesn't mean that we have to just let a wildfire burn, expand as far as it wants to, cause as much damage as it wants to, and then it just puts itself out. We can and do things to try and avoid and mitigate how much damage it can cause. And instead of the fire department, we have the Federal Reserve. The Federal Reserve and recessions are kind of the firefighters and the fires. Monetary policy is this big blanket term to explain how our government tries to poke around and change things to try and make sure the economy is growing in a long-term sense, in a healthy way. So, with the Fed's ability to control monetary policy in the US, they can both help resolve recessions that happen involuntarily, or they can cause recessions by tightening things up, starting a controlled burn, and allowing it to burn before putting it out. Think of the feds again, like the firefighters. If and when it's necessary, they can step in and start a fire and put it out when they feel the time is right and the economy is back in a situation or position that is healthy. Or they can try and put out naturally occurring fires. By adjusting different monetary policies, and we're not going to get into that right now, I have an entire webinar on the Federal Reserve called Federal Reserve. If you, by the way, quick side, if you do not have an account for Sectors Made Simple, I highly recommend creating an account and checking out all of our webinars. We offer over 100 hours of free-to-watch webinars like this one over on our Learn site, learn.sectorsmadesimple.com. There is no limit to how many of these webinars you can watch for free. We don't require a free trial or a credit card to start watching these free webinars. Create a free account, log in, and start learning. Now, back to today's presentation. The Fed has the goal of trying to influence the direction of the economy and help rein in certain things that might get out of control, like inflation, consumer prices and spending, and unemployment. Again, sometimes they will intentionally cause a recession. We've seen this in the past. But other times, due to global events, global pandemics, recessions will cause themselves. So the Fed can step in and try and handle and tackle those naturally occurring fires as well. But as far as trying to cause a fire, a controlled fire, and then eventually put it out, that's about where we're at today. The Fed is causing a fire, and they're in the process of putting it out. Now, we need to talk about this idea, this concept of a soft landing. Romulo already said it in the chat. a soft landing is the Fed's goal. So, to kind of give a little bit of context behind what this is, when economic conditions are strenuous, when it's putting stress on businesses, but more importantly on consumers, due to high rates of inflation and decreased consumer spending, the Fed will attempt to put downward pressure on our economy. Meaning, the Fed will intentionally try and push things down and start a small fire to get things moving in a long-term, productive way. Reason is that decreased economic activity will slow inflation and help bring it back down over time. But just like this can be a tool to help, it can also cause damage. Because when the Fed tightens monetary policy too much, that has, and also could in the future, lead to recessions. This is how a lot of recessions begin. The Fed wants to tackle inflation, they rapidly increase the federal funds rate and federal interest rates, they tighten up on monetary policy in the US, they take it a little bit too far, the economy tanks, we enter a recession. Through that recession, we see rapid decreases in inflation, rapid increases in unemployment, people get stressed out, but the economy gets back on track. Then the Fed loosens up on their policy again, and the whole cycle begins anew. That's what usually happens. But that's not what the Fed's goal is right now. The Fed's goal right now is a soft landing. And a soft landing is an approach where the Fed tightens monetary policy just enough to bring inflation back under control. Just like Goldilocks' soup. It's not too hot. If it goes too hot, leads to a recession. If it's too cold, it doesn't tackle inflation. When it's just right, inflation goes back down, but unemployment remains low, and consumers get out pretty much unharmed. So that's the goal, but now let's ask the question, how realistic is it? How realistic is it that the Fed is able to achieve a soft landing, and more importantly, that they've done it before? Yes, they actually have. They've done it once. Back in 1993 to 1995, the Fed was able to bring inflation back under control without causing a spike in unemployment or any sort of consumer metrics, both how they felt about the economy, their consumer spending, and more. But the 90s were a little bit different than they are now. Because back then, the rate of inflation that they were trying to tackle was about 3%. And there was not this dying need for them to intervene. They decided to step in because we were recovering from a full recession, and that recovery stalled out, above where the Fed wanted it to be. So the Fed started tightening policy again to try and bring that rate of inflation back to their target, which is around 2%. So, in my opinion, there wasn't much damage that they needed to fix, and their decision to tackle inflation was largely proactive. They tried to address it before it was an issue, and when it was a small issue, instead of looking at a wildfire burning out of control, saying, all right, bring in the helicopters, bring in the planes, we've got a lot of work to do. Fast forward to the 2020s. In 2022, CPI inflation, which is one of the two main inflation metrics we have, reached a peak of 9.1%, over triple the rate of inflation back in the 90s. And the Fed didn't start improving or didn't start addressing monetary policy changes until that inflation peaked. So, in my opinion, the Fed's policy changes here, the way that the Fed went about solving inflation, was entirely reactionary. They didn't see inflation increasing and try and step in right away to do something about it. Instead, it peaked. Then they looked at it and said, well, shoot, that's a problem. Let's do something about it. So, in my opinion, the background and the circumstances surrounding the soft landing that they succeeded with and what we're seeing today are completely different. One, inflation just stalled out, and they just wanted to nudge it back under control, and they were proactive in doing so. Here, inflation was triple what it was back in the 90s, and the Fed's policies came in as a reaction to that sky-high inflation. So that's why inflations matter to the average American. But after all, we're an investment company. Why does inflation matter? And more importantly, why do recessions matter to investors? Well, I mentioned before a little bit about the economic cycle. There is also a connected cycle called the market cycle. The stock market cycle and economic cycles work together and are connected, where the market cycle has historically led or preceded the economic cycle. To expand on this, bear markets typically begin when the economy hits its peak, and bull markets begin when the economy hits its bottom or trough. This is why something that I fully believe is that one of the best times to learn how to invest and to start investing is during a recession. Bull markets begin in recessions. Don't wait until the economy is doing incredibly, because usually by that point, the market's already peaked and is starting to show the first signs of weakness. Expanding on that idea, there is this idea known as sector rotation, or that different types of companies that do different kinds of things work better or worse during different parts of this cycle. It is the reason that sector rotation exists, and it's the reason that sector rotation is one of the key values, one of the key investment strategies that we teach here at Sectors Made Simple. So to us, the economic cycle matters a lot. But I want to quickly show you that first, it's not me that is saying this. This is something that is well established by many, many, many credible resources out there. But more importantly, here's a picture explaining what I just talked about in visual terms. The orange cycle is the stock market cycle, where we see a bull market, market top, bear market, and then resetting on the left side, market bottom. At the same time, we see the economic cycle in blue, where we see a full recovery, early recession, moving over to the left side, full recession, and then early recovery. As we can see, the orange market cycle comes before the blue economic cycle, where we see a market top occurring about halfway through a recovery period. And we see a bull market beginning, the trough of the orange, occurring as the full recession is in full swing. Above, what we see are 11 different sectors. These sectors encompass every company in the S&P 500 and really the entire stock market. But what it tells us is that, for example, during a market top, the materials, energy, and consumer staple sectors perform the best. As the market begins to decline, we find that defensive sectors, such as consumer staples or like the I need thems in your life, the Walmarts and the like basic consumer staples goods, toilet paper and all of that, they do pretty well. Healthcare does well. We always need healthcare and utilities. Utilities, again, we don't get an option. Those are the must-dos in life. As economic policy begins to tighten, and as it begins to improve, we see other sectors such as technology, consumer discretionary, which is luxury goods, and communication services rising to become sector leaders, moving back in towards industrials, materials, and the whole cycle repeats. So, that's why it matters. It matters, 1, because we are all part of the economy. 2, because the market and economic cycles are connected. And 3, we can turn these cycles and understanding them into actionable trading strategies by understanding that sector rotation is connected to these other 2 cycles. Pretty cool, right? Now, a soft landing. It's a great dream, but is it realistic? How tough is that? Well, in my opinion, it's way easier said than done. And also, answering the questions, are we in a recession? Did a recession happen? And is a recession coming? Are all really difficult questions to answer. Because there is no one person that sits there and says, I have the authority to say we are in a recession. Today, I decree we are in a recession. No one has that power. Maybe there's some Illuminati thing but no, there's no one that decides we are in a recession, we are not in a recession, and also recessions are not this black or white idea. Economic pullback is continuous. There's an area that we will say would be a recession. There's an area we'd say would be a depression. But in between neutral, nothing happening, and recession, there's still a lot of room. So the reality of this is, every single person will have their own opinion and their own answer to this question. Now, before I start telling you about my answers and my reasoning, let me share with you a financial institution's opinion, a company you're probably familiar with, Fidelity. Fidelity gives us an idea of where they feel that we are in this cycle. Sorry, give me one moment. Alrighty, my apologies. So again, each person will have their opinion, and moreover, we can look at the opinion of something like Fidelity to realize why their reasoning is different than mine, but also that opinions will change over time. So Fidelity believes that the US economy is entering and moving through late expansion, meaning we're about right here. We're starting to decline in this cycle. Now, that's interesting because, again, I say that we are moving out of a recession. Fidelity, with all of their research, analysis, and resources, believes we are entering a late expansion stage. But their opinions change. Just a few months ago, they believed we were entering a recession. They felt that we were right at the beginning of a recession. The recession was right around the corner. And that was their belief. Not just for quarter 1 of 2024, or quarter 4 of 2023, or beyond. That was their belief for over a year. I went into Wayback Machine to see how long their opinion has been that, and as far back as I could look, which was about a year, a little bit over a year, they believed that we were entering a recession. So, their opinion has gone from we are entering a recession backwards to now we are entering late expansion well before a recession. Now, while this cycle does exist, it is technically possible for it to go backwards. But The real value here isn't to try and say why Fidelity's wrong and I'm right. Again, they're all opinions. What I want to showcase in this example is that it shows how uncertain opinions can be. I have an opinion, Fidelity has an opinion, hopefully by the end of this webinar you will have an opinion. And none of those opinions are any more valid or correct or incorrect than others. And it also shows how uncertain these opinions can really be, even from financial institutions. So, instead of trying to draw everything back to one singular answer, yes, no, or where we are in this crazy cycle, let's just look at the facts. So, I don't want to just give you all of the facts with no context. Instead, let's look at the reason for all of this and for why the Fed is trying to get so involved in monetary policy right now, and how they've been adjusting one of their largest resources to tackle inflation, known as the federal funds rate or federal interest rates. As of March 2024's data, CPI inflation stands at 3.5%. Federal interest rates sit at 5.25% to 5.5%. CPI inflation, how much things are increasing in cost over time for us. Federal interest rates are the rate that banks can lend to other banks for, and ultimately sits below any sort of commercial or consumer loans. So if you go to buy a house, you're going to pay this 5.25 to 5.5% plus whatever they want to tack onto it, which results in something like 30-year mortgage rates currently being around 7.6%. It's the 5.25% plus their share. Now, this is March 2024's data, around 3.5%. Tomorrow, May 15th, we will receive the inflation data for April of 2024. And that's the reason why I felt that it was so important to do this webinar today. This inflation report is going to shape the market for the day. Right now, we've seen the market pretty quiet the past day and a half, 2 days, because they're all waiting for what happens tomorrow. So, with that said, now we've talked about the big things, let's get into the little things and look at all of the different economic data pieces that I used to form my opinions. In the interest of time, I'm not going to go through every single one of the charts. I do encourage you, if you're interested, to go through every single one of the charts. They are all listed down in the description below. Let's start. GDP, or Gross Domestic Production. Since the end of the pandemic, we've seen GDP dip negative for 2 consecutive quarters, meeting the economists' definition of a recession. But this didn't happen recently. No, this happened back in 2022. Quarter 1 and quarter 2 of 2022, we saw GDP decline. Now, since then, GDP has been positive. This one I actually will show because I feel that it is fairly important to the whole conversation. Looking here at the federal interest rates, what we've seen is that in quarter 1 and quarter 2, it dipped negative. And since then, it has been positive, but it has been declining slowly since quarter 3 of 2023. So while the data has been positive, it is declining over the past 3 quarters. Quarter 1, 2024 GDP is currently reported. They do provide the initial numbers and then they provide revisions of it over time. But the current revision has quarter 1 of 2024's GDP at 1.6%. According to the Atlanta Federal Reserve, by the way, a lot of the data we look at comes from government agencies and organizations. Federal Reserve branches included. So quarter 2 of 2024 is forecasted, their GDP is forecasted to be positive, with an estimate of above 4%. Again, if you are curious about that, it is linked down below. It is coming from the GDP Now tool, pointing to the Atlanta Fed's GDP Now estimate. Again, I'm going to provide the sources for the first few things and show them, just so there's some idea of how I look at this data. But the long and short of that is that the Atlanta Fed sees sees GDP going up in quarter 2, and the Federal Reserve itself, the Federal Reserve Board rather, shows positive GDP growth for 2024 as well. Now this is year-end 2024, but their forecast for GDP is 1, positive, and 2, has increased from their December of 2023 estimate to their estimate they provided in March of 2024. So, moving past the numbers, here's my opinion. The reason that the 1970s economists' opinion of how we define a recession is still valid is because GDP data has become the gold standard for gauging recessions and depressions. It's the one number that can potentially rule them all. So, piggybacking off of that, while I do believe that the 2 quarters of GDP losses in 2022 were significant, I believe that those 2 quarters were an indicator that we did see a minor recession in 2022. And that I feel that most of the policymakers' forecasts, from the Federal Reserve Board themselves to the Atlanta Fed, to also in that Atlanta Fed doc, it includes the blue chip estimates for GDP. They are all positive, showing GDP growth throughout 2024. Now, unemployment. This is the one that probably matters the most to you, because do you care about GDP? Probably not, and I don't blame you. Do you care if people have jobs or not? Yeah, you probably do. This is one of the most felt effects of a recession. People losing their jobs hits us hard at home. How this comes about is that money being more expensive to borrow means that people aren't spending as much. Decreased profits result in layoffs. Layoffs result in people losing their jobs, which then causes consumer spending to go down again, and then that causes more decreased profits, and just see how this kind of spirals. Well, thankfully, April 2024's unemployment rate was 3.9%. Now, this is very, very important, because historically, throughout recessions, there have been large spikes in unemployment, from the beginning of a recession through to the end. And the lowest peak that we have ever seen in a recessionary period was 4.8% back in 1970. Every other recession has resulted in over 5% unemployment rates. So my opinion of unemployment is that this, to me, is the smoking gun. This, to me, is the one metric I look at and say, I don't think we're going to have a recession. Because the impact of these changes in monetary policy aren't resulting in a spike of people losing their jobs, and people keeping their jobs. Yes. Do you personally feel like your money isn't going as far? Yes. Do you feel the challenge and the tightening of the economy? Yes. But as long as people are retaining their jobs, we can weather short-term losses. Collectively, we can weather short-term challenges. Traditionally, recessions bring with them extreme levels of unemployment, but also those levels of unemployment rapidly increase. And these rates don't just spike up and then drop back down. Instead, these rates often last for months, or even years in some cases. So again, going back to the Federal Reserve Board's Summary of Economic Projections from March of 2024, they project that unemployment at the end of 2024 is going to be 4.0%, amended from their December 2023 estimate of 4.1%, if I recall. That's well below 4.8. That is well below any rate that we've seen in other recessions. So because of that, if we don't see a sharp rise in unemployment, which I fully believe is viable and reasonable, I remain confident that we will not see a full-blown recession. Now, consumer spending. This one is a big topic because there's a difference between consumer spending, how much people are spending, to consumer confidence, which is how people are feeling about what they're spending their money on. I just chose one number. I encourage you, if this is something that you're curious about, to go check out the Michigan Consumer Sentiment Survey. That isn't linked below, but Google's got your back. I will focus instead on consumer spending, the dollars side of things. Remember back to the National Bureau of Economic Research, their definition of recession includes a decrease in consumer spending. Based on a Bureau of Economic... This is the one I always forget for some silly reason. Bureau of Economic Analysis. Straightforward. Based on their data, March 2024 showed a 0.5% increase in consumer spending. That's an increase. But the last time that we saw the consumer spending not increase month over month was in Q1 of 2022. Since then, consumer spending has consistently increased. Historically, during recessions, consumer spending has decreased, just like the NBER definition. Now, this one, I'm not here to sell you on my idea that no recession, in my opinion, is completely one-sided. There are elements of this that I look at and I'm like, not as comfortable, not as 100% sure no recession. So take this number with a bit of a grain of salt. Don't just believe this number outright. Reason is that we are still in high levels of inflation. And back to 2022, we were in hilariously high rates of inflation. So the increase in spending could be that people are spending more, or it just could be that we have to spend more on the goods and services that we need. So inflation going up also means that how much we spend is going to have to go up if we're keeping up with what we were purchasing. But despite that, no decrease in spending is a marker against a recession, in my opinion. Despite most recessions carrying with them high rates of inflation that decrease throughout the duration of that recession, they do have decreases in consumer spending. So seeing consumer spending remain high is an indicator of that. So this is not immediate cause for concern for me, but again, we shouldn't just look at, well, consumer spending go up over time. Good sign. There's more to it than that. That's just the brutal truth of it. Now, moving on. We have the Manufacturing PMI, or Purchasing Managers Index. This big confusing word basically just means what's the dollars and cents of the manufacturing industry. The reality is, manufacturing is an important intermediary process for taking raw goods and turning them into things that we buy. These industries can expand, and during periods of economic challenge, due to rising costs on the production side, and then decreased demand from the consumption side, these industries can shrink or contract. So this index is on a scale of 0 to 100, where 50, the middle point, is considered to be a stagnant industry. It is neither growing nor expanding. Anything below 50 is considered contraction. Anything above 50 is considered expansion. Cool. Where are we at? Well, there are two main manufacturing indices. One is the ISM and one is S&P Global. I'm going to be focusing here on ISM. ISM's manufacturing PMI for the United States for April 2024 was at 49.2, contraction, down from 50.3 in March. Just inching out on the expansion side. This number, though, is still an increase from the local low of 46 in 2023. Local low here basically means since all of this discussion about a recession started, this is the lowest that we've seen. It has 100% gone below 46 in the past, alright? Speaking of, here's my opinion. 49.2 is a technically contracting market, but it's just barely underneath the 50. We've seen the low of 46. That's a little bit more. But the reality of it is, during other recessions in the past, these manufacturing PMIs have crashed well below 40. So, to me, 49.2 is hanging in there. 46 is, it could be worse. Below 40, now something crazy is happening. And also, we've seen the PMI bouncing between 49 and 51 for a little bit. So seeing a sustained period, a longer term period of minor contractions, in my opinion, not cause for alarm. Again, in past recessions, we have seen a sharp, immediate decline in manufacturing PMI. And that, again, is a sign of other recessions and how they have resulted in a hard landing. More of a, not so much a soft landing, more of a hard bounce or a splat. This one I actually do want to show you. Let's take a look together really quick at the manufacturing PMI. So, let's make this a wee bit smaller, please. There we go. All right. Here's the manufacturing PMI for the past year. Again, we see that it is down to 49.2 and reached a low of 46 back in 2023. It's gone down that low before. It's gone well below that before. And we don't need to just look at COVID to see it go down that low. There have been many points that the PMI falls well. This isn't even the bottom, by the way. The bottom is somewhere around 30. Back in 1980, 30. So seeing the PMI not decline, seeing the PMI rapidly crash is not outside of what is possible. Looking a little bit closer now at what's currently happening, we've seen a slow decline and a stagnation. There is no immediate crash and rapid recovery like we've seen in other economic downturns. So, in my opinion here, this is another straw in the hat, or another feather in the cap, that's the analogy, behind my reasoning that this is not an indicator of a recession, instead is the indicator of economic pullback. Do I feel that we are in a period of economic pullback? 100%. Do I think that that economic pullback constitutes a recession and should be treated with the same panic of a recession? Well, first, I don't think a recession should warrant panic, but no, we're nowhere close to that. Now, let's address the elephant in the room. Inflation. This is the one. This is the one that you'll see, you'll hear about in the news. This is the one that everyone's following. And guess what? This is the one that is going to throw an absolute just wild card for the market tomorrow. Now, inflation isn't actually just one number. It is actually 4 numbers of 2 different metrics, CPI and PCE. Both offer the exact same 2 types of inflation. They offer all inflation, which is known as the headline, mostly because that's what you're going to see when you read a news article. Inflation rises X%. That's probably headline inflation. Then there is also core inflation. Inflation that takes out very, very volatile and cyclical industries, such as food and energy. So headline, everything. Core, inflation minus food and energy. CPI is going to look at, and again, here's where they are different. They're both the same in that they offer headline versus core, but CPI inflation looks at out-of-pocket expenditures, basically how much are people spending, but only for urban households. PCE is a little bit different. PCE measures changes in goods and services consumed by all households. In my opinion, if you read a news article, it is more likely they are going to focus on CPI. Why? Because in recent years, the CPI has been the higher one. It's the one that gets more clicks. That's the reality. While news stations might favor CPI because it's more inflammatory, the Federal Reserve prefers the PCE inflation metrics because it is a more complete metric, or it's a more inclusive metric. As to not play favorites, I'm going to share with you both CPI and PCE. First, CPI, because again, that's the one coming out tomorrow. CPI inflation, again, is that 9.1% number that we saw back in June of 2022. This rate was rapidly brought under control. The Federal Reserve managed to get this rate down to just 3% by June of 2023. But this is still technically above the Fed's target of 2% inflation. Since June, that progress has stalled and actually gone backwards a little bit. Since then, we have seen this rate slowly tick back up, with March 2024's inflation data sitting at 3.5%. But looking at core inflation tells a little bit of a different story. Everyone is going to look at the headline inflation because guess what? It defends the point that things aren't going down anymore. The Fed isn't achieving their goal. Look at this. It's stagnant. It's going sideways. Ah! Here's core inflation. Headline. Core. Which one do you think is going to get more clicks? Inflation has been stagnant for over a year. Or for almost a year. Inflation has steadily declined for the past year. Bad news? Good news. Which one do you think sells better? The reality of it is, bad news always sells better. So, the reality is that inflation isn't as bad as we might think. But before we get to my opinion, what's PCE have to say? Maybe PCE is different, right? Well, I'm going to run through this pretty quick because you already kind of know the numbers that we're going to be looking at. Headline inflation peaked at 7.1% back in 2022, same month as CPI, and has been declining ever since, mostly. It has stalled out in some weeks, but on the large scale of things, it has steadily been declining. Where March 2024's headline PCE sat at 2.7%, still above the target of 2%, more work needs to be done. But, just like core CPI inflation, core PCE inflation has consistently declined from a peak of 5.575% back in early 2022 to 2.8% in March of 2024. Again, this one I do want to highlight. So, here's headline PCE inflation. Again, it has regressed some and is increasing right now. But the minute you look at core, these are not the same graph. They might look similar. This is CPI, this is PCE. They're both going down. But this story doesn't sell. This story does, this story does. That's the reality of it. So, what's my opinion on inflation? The Fed has done an incredible job of tackling inflation. We saw inflation up above 9%, and we saw PCE inflation also well above 7%. So the fact that they have gotten it back to where they have, in the amount of time that they have, with the minimal negative impacts that they have, that's commendable and that is incredible. Now, while CPI inflation has stagnated, headline, CPI inflation has stagnated in the past few months, myself, but more importantly, FOMC Chairman Jerome Powell remains confident that additional tightening isn't necessary. Today, Jerome Powell had a speech in which he mentioned that he does not see the Federal Reserve having to tighten the interest rates or increase interest rates more this year, and that the chances of a decrease in the federal funds rate are way more realistic. So if additional tightening isn't necessary and the Fed is committed to the fact that they can keep unemployment low, consumer spending high, or good, and bring inflation back under control, that's a pretty darn good sign to me, and hopefully should be to you as well. Now, let's get to the not so fun one. The one that is the boogeyman for me. The bond yield curve. This one is a much lesser known economic indicator, but is also one of the most consistent leading indicators of recessions. What happens is that the US Treasury issues bonds with varying lengths of maturity. Basic idea is that the longer they keep your money, the more interest they need to give you, right? But during periods of economic uncertainty, recessions, bond yields for shorter term securities can go up. And sometimes they can outpace longer term bonds as well. That is where the bond yield curve comes from. It looks at the difference between 10-year bonds and 2-year bonds. And what happens when the 2-year outpaces the 10-year is known as an inverted yield curve. Now, this bond yield curve is one of the most consistent metrics for gauging a looming recession. It has gone negative 7 times since 1976. 6 of those times, a recession immediately followed. And the only time that we saw the bond yield curve go negative with no recession was in 1998. And the bond yield curve inverted for 1 month. That's it. Now, since July of 2022, the bond yield curve has been inverted. And this is the longest period of time that the bond yield curve has remained inverted. We are approaching 2 years of an inverted bond yield curve, over double that of the previous longest period, which was 10 months back in the year 2000 with the dot-com bubble. But what's my opinion of it? Well, a lot of people are going to point to the bond yield curve as being a predictor of a looming recession, because past history shows that that is the case. But as we've looked at in many other indicators today, I see this differently. The fact that we have been in the bond yield curve inversion for so long is completely new, completely novel. This is not something we've seen before, because it's also one of the few times that the Fed has attempted, for a long-term commitment, a soft landing. So we don't have prior data to go off of to say this is how the bond yield curve reacts to a long-term Federal Reserve commitment to a soft landing. So this might just be the result of the Fed's very slow adjust and then monitor stance. And also why, if you look at the bond yield curve, in contrast to other periods where the bond yield curve spikes down and immediately increases, we are seeing a negative flattening instead of a sharp decline. All right, that was a lot. Let's quickly summarize. Recessions are a type of economic pullback that are fairly common in the US economy. Pullback is unfortunately a necessary piece of the economic cycle. But the question of recession or no recession is not black or white. The Fed remains committed to trying to rein in the rate of inflation without dipping the economy into a recession. Will we see economic pullback? Yes. Are we experiencing economic pullback to some extent? Yes. Will it fall into a full recession? I don't think so. And based off of economic projections and economic data releases that we are getting, I fully believe that a soft landing is still possible. But the reality is, the entire world does not listen to me. The entire world does listen, and especially the investing world does listen to CPI inflation data. So, with that said, keep your eyes out tomorrow morning. Before market open, we will receive the CPI inflation data for April of 2024, and it will certainly set the tone for the trading day. Keep your eyes peeled, stay informed, and remember that Sectors Made Simple is always here to help you learn more about the market and why understanding it better can help us to invest simpler. Before we end out things today, I hope that you enjoyed this material, and for those that have stuck around this long, thank you. You've learned a lot today, hopefully, and to try and help you benefit from the information you've learned today, over the next few days, we will be releasing a number of different little quizzes on our social media channels. These quizzes will have a question, and if you answer that question, if you DM us that answer correctly, we will give you a free month subscription to Sectors Made Simple. Pretty cool, right? So, if you're interested, check out our social media channels. Follow our Instagram, YouTube, TikTok, and Facebook, and stay informed because when those questions go live, the first person to DM us the correct answer will win. So, all of our socials can be found on our website or at the bottom of our different newsletters. So, thank you all so much. Hope you stay tuned for the remaining posts that we have scheduled for you all this week and those nice surprises in store. Thank you all so much. Take care. Bye.